It's time for Yahoo Finance's Market Minute. Stocks are sinking amid renewed recession fears as U.S. GDP contracted for the first time in 3 years, declining at an annual rate of 0.3% in the first quarter. Meanwhile, the Fed's preferred inflation gauge PCE came in line with expectations. Big tech earnings and Friday's April payrolls report are the next key tests for markets. In individual company news, Starbucks delivering a weak second quarter, missing on revenue and earnings while reporting a same-store sales decline for the fifth consecutive quarter. Still, CEO is expressing optimism about the company's turnaround plan. And Supermicro Computer on track for its worst day since February. The company lowering its third quarter guidance, citing delayed customer platform decisions. And that's your Yahoo Finance Market Minute for this morning. If you want to follow more of what's trending on Yahoo Finance, you can scan the QR code below, where you'll be able to track the best and worst performing stocks of the session.
Welcome to Wealth, brought to you by Synchrony. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. And on today's show, Tech Investing Playbook. We discuss how you can think about investing in AI and some top picks in the sector. And one strategist tells us why muni bonds, those municipal bonds, may add value and safety to your portfolio right now. Plus, Meta Platforms launching its own AI assistant app. Our own tech editor, Dan Howley, breaks down how it compares to the likes of ChatGPT. All that and much more coming up during the hour. But first, let's take a look at some of the market action. We're 90 minutes into the trading day. Stocks falling after negative GDP data. The U.S. economy contracting for the first time in 3 years. Joining me now, we've got Mike Bailey, FBB Capital Partners, Director of Research. You're looking at companies that can adapt to new tariffs and find creative ways to grow. How can investors locate these opportunities?
Absolutely. So they're certainly everywhere. You just take a look at the S&P 500. You can look at the top of the list, kind of work your way down. I think for us, as we're thinking of again, navigating some pretty choppy waters here, tariffs, when are they going to happen? How big are they going to be? Is it going to drive a recession? A lot of questions out there. A few things to think about. One is quality. You're buying a quality business. What does that mean? Generally, is it a more profitable company? So that's something that can help you out. If you're a big company, profitability is pretty good. If the tariffs kick in and they're pretty challenging, you've got a little bit of wiggle room there. You're not going to maybe get crushed as much as sort of a low quality company that's barely scraping by. So that's something to think about. The other piece is diversification. So if there's a business that's doing 2 or 3 different things, you can talk about maybe Amazon. They've got e-commerce. They're doing cloud computing. They're doing online ads. Things like that, the businesses that've got scale and diversification, they can sort of minimize some of that risk that may hit more concentrated companies.
And so, Mike, with that in mind, as we were breaking down some of the latest economic data, how are you kind of reading through and assessing companies that are best positioned to weather any type of GDP or broader economic contraction?
Yeah, that's a great question. In general, if this is, let's put aside tariffs and say, hey, this is just a regular economic cycle. It goes up and goes down. If the economy is shrinking, typically more defensive type companies do better. So you're looking at consumer staples, maybe utilities, could even be telecoms or pharma, for example. So those companies tend to do, you have to go out and buy these type of products or use them regardless of the economy. So that tends to be the part of the economy that's done better. Those sectors have done okay this year to date. I think investors are worried about a recession. So that's generally kind of the starting point. However, I think the caution is that if you sort of put everything in your portfolio into that safe part of the market, as the economy turns and improves, you're going to miss out on the everything else kind of recovering faster, cyclicals, tech, and growth, et cetera. So certainly important to be diversified in that portfolio, but keeping an eye on some of those safer defensive names, definitely keeping some of those in the portfolio this year will be helpful.
Right, and as investors are once again hearing even more of the R word getting tossed around here on the day in recession, important reminder that the technical is typically 2 quarters of consecutive contraction here on the GDP front. And then even after that, we still got to wait for the NBER to come out and say, okay, yeah, it's happened, and we'll validate this. And they look across a range of factors. All those things considered here, Mike, I wonder, what is your top thesis right now prevailing in the markets, especially given some of what's expected to be continued chop?
Yeah, absolutely. So just looking at, where markets are now and kind of what's next, I think we're kind of viewing things as frankly a tug of war. So markets are down about 10% from recent highs. That's sort of almost a no man's land. If there's a recession, stocks are going to be down probably 20% plus. If tariffs go away, there's no recession, we probably flip right back up and go back to where we were back in, kind of February. So it's a little bit, there's definitely some tension here. As we're thinking through what's next, we do see, tariffs having a significant impact already. We're seeing slowdowns in international shipping, seeing some kind of tea leaves suggesting that things are slowing down. So I do think there is a risk of a bigger economic slowdown. And yeah, I think investors, again, you do want to make sure you've got that diversified portfolio. Make sure you've got some safety or defensive type stocks to own. Maybe you own a little bit more now. Again, wouldn't go too much overboard there, but that's kind of where we're looking. Again, pretty tricky here. Again, the policy is changing hour by hour, but I do think some of the stuff that's happened is leading towards slightly higher odds of recession. You want to make sure your portfolio at least has some protection in case that does happen.
Just lastly here, Mike, how should investors be thinking through their portfolio as to whether or not the companies that they've invested in or sectors that they have exposure to will actually see exemptions come their way? And I guess within that, is relief enough of an investment strategy, especially knowing how much of some of the contraction that we've seen in the market pullback is self-induced?
Yeah, absolutely. So yeah, I think it's certainly the big question. Now, which companies will really feel the heat if tariffs kick in a big way? So at this point, we've seen a few things around the edges. We've seen airlines kind of see some pressure. We've seen shipping and transportation see some pressure. Other than that, it's really been kind of hit or miss. We really haven't seen a clear indicator of which companies really are going to see a lot of downside. So we're going to have to sort of wait and see. And that's certainly not a great answer, but I think that does get back to diversification. And I think you're going to see a lot of surprises. One example could be in healthcare and pharmaceuticals. Certainly there are some tariffs threatened that could be coming against drug companies. However, big global multinationals are out there saying, even if tariffs kick in, some of these big companies with scale have the ability to start moving around their supply chains and make local and sell local, so that can minimize some of the tariff risk. So really a lot of moving parts. I think given the unknowns, it's really important just to stay diversified. Make sure you've got some of these quality companies that kind of are doing different things, and that's probably the best way to go.
All right, within that wait and see, some more volatility is expected here. Fortunately, I've got my floaties. Mike, thanks so much for taking the time.
Thank you.
Now time for some of today's trending tickers. We're watching Etsy and Airbnb. Joining me now, we've got my Morning Brief co-host, Madison Mills. Madison, first up, we've got to talk Etsy. Reversing earlier gains after reporting a beat on revenue in the first quarter. Some analysts say that the results were better than feared, but the stock, as you can see, is falling. It's down by about 7.25% right now, just about 90 minutes into trade.
If you caught me sort of staring into the camera there for a second, it's because I was awaiting that stock price, because I'm fascinated by the degree of downward pressure we are seeing on Etsy right now, given the results of the quarter. As typical for a lot of these earnings, what is the problem? It's what's going to happen in the future, because the stock market is forward-looking, and that is perhaps why you're seeing shares down so much. The results, though, were better than feared. We had a couple of bright spots. Advertising revenue, unlike Snap, was better than expected. Building demand at Depop as well. That is their kind of vintage second-hand platform for consumers there. And those results better than feared, though Citi noting that shares are likely to be range-bound until there's more clarity on the company's direction moving forward. KeyBank also noting the outlook points to sequentially lower profitability and continued softness moving forward. And several of the analyst notes coming in here talking about how that outlook moving forward is the sticking point and key issue, especially as we continue to hear from several companies and even from the economic data this morning of a softening macro environment.
Yeah, it's really interesting, especially given that Etsy has been one of those companies that investors look at and evaluate how the business does when there's the absence of excess cash in the consumer mindset here. And as we're looking at the makeup of services versus goods spending, and the necessary services, really getting that prioritization. Yeah. Etsy is one of those businesses where you can, and have in the past, been able to see that kind of correlation as well here. So worth continuing to track, as well as this next business, Airbnb, upgraded to buy from neutral at D.A. Davidson. The firm lays out 4 key reasons for the upgrade here. As we're taking a look at shares of Airbnb, the shares are down by about 4.6%. Oh yeah, I might add that this company is also going to be reporting earnings earnings this week too.
Yeah, I think it's fascinating to have this upgrading to buy headline pass through my feeds this morning, right as we were getting earnings in from the likes of some other travel names, including Norwegian, which showed a lot of weakness in consumers this quarter. Some of that weakness playing out in Airbnb stock. It's down over 4.5% despite this upgrade from D.A. Davidson to buy. They note 4 reasons here. They talk about resilience of online leisure travel, aka you're going to switch to Airbnb maybe instead of using your hotel because maybe it's a little bit cheaper. Inventory breadth and depth and a focus on affordability. Maybe that again is a tailwind for them as consumers look for a more affordable Airbnb versus a hotel. Also talking about the new product cycle. They've got a tech stack development in the works here that could bring more profit to come moving forward. And then they talk about the company's recent valuation as well because of that recent 23% pullback in the shares over the course of the last year, trading at about 16.5 times their lowered 2025 EBITDA guide. So talking about that valuation and then a couple of key pieces of the company as potential moves to the upside to come in the future.
You know, all due respect and great respect for the team over at D.A. Davidson, but there are some issues that I take with this, and only because of the environment, again, on the consumer front that we find ourselves in, where a lot of consumers typically, when they are pulling back on some of their vacation spend, or there's unclarity around how much they're willing to spend, they look across where they can deploy points and rewards. And that has been one area that has left kind of investors perplexed a little bit when it comes to some of the Verbos of the world or the Airbnbs of the world. How are you going to be able to leverage some of those points and get a similar experience that you would on some of the other accommodations play? Think Marriott, think Hilton, think the historic hotel businesses as well.
Right.
So that's just one that I think is going to be interesting to see how the business and Airbnb continues to discuss that in this environment going forward. And we'll see what they say on Outlook when they report this week as well.
Really great point there, Brad.
Maddie, thank you for joining us.
Thank you.
Coming back here on set, you can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. This week, we're talking all things tech investing as we get results from some of the biggest names in the sector, one of which is Meta Platforms, making its next AI play by announcing an app meant to rival here ChatGPT and other assistant competitors like Claude and Gemini. And so we want to dig into one of Wall Street's hottest trades, artificial intelligence. Here with us, we've got Kimberly Forrest, who is the Boca Capital Partners founder and Chief Investment Officer. Kimberly, good to have you back here with us. Today we're talking about how investors should think about investing in AI. I'd love to just start with your overall thesis here for picking companies.
Sure. Well, I come to this industry from software engineering where I was doing AI. Can you believe the luck of that, right? So today is your lucky day. But regardless, I started in the industry in '99 where .coms were a craze. I did not fall for them because I had worked in software, and I'm looking at them going, I don't really get it. This company doesn't have a product, or this company is years away from delivering the product. So I have a very practical approach to looking at and evaluating technology. The first thing I ask is, what problem is this technology solving? And then at what price can it be delivered? And if that price is higher than the product or than the problem that it's being solved, I take a pass on it, and that might hurt, like in the short term, but you're going to be right in the long term. So that's what I'm doing, is I'm evaluating all this new AI stuff, saying, what problem does it solve and what's the price to deliver it?
Yeah, no, that's really brilliant. So as we're thinking about the investing and the different buckets, there are kind of 3 main buckets of generative AI investing. And, you know, I kind of harken back to what we had heard from Mark Zuckerberg many moons ago. I think it was about 2 years ago, essentially, when he was laying out the vision for what their own investments would look like. And he kind of laid out the investment thesis as well in the buckets: applications. Those are the products that people get to use, like ChatGPT and Microsoft Copilot. There's also learning models, the so-called engine under Gen AI applications, such as ChatGPT-4 or GPT-4 rather, which powers ChatGPT. And then there's the chip makers that all of this sits on top of, and the data centers like NVIDIA and Taiwan Semi. So break down how you think about investing in each of these buckets, and perhaps we start off with applications where consumers are touching it.
Sure. Well, I think it's important to note that most of the stuff that we're doing is a replacement for search engines. And there's a good reason for that. People who want to use a search engine want to get an answer to a question, not kind of figure out what the sentence should be to the computer and then scroll through all of the links that come back as potential answers. So at the face, ChatGPT lets you ask a question and it gives you an answer. Now, how much are you paying for that? You might be paying the $20 a month or whatever to get premium service, but I'm thinking that is way, way under what it costs to deliver that service. So in the long run, either the price of computing has to come way down, or the price of accessing that has to come way up. The other thing is, if you're an investor in Google, you really have to watch this because, you know, ChatGPT and friends are eating Google's lunch. So that's one thing. I think playing the semiconductor layer is really smart because we don't really know what the end application is going to end up at, what problem it's really solving, because there's a lot of problems. But we know that it's going to be delivered on a chip. So that's been an area that I've been playing for the last, well, we'll say 6 years, not necessarily in reaction to AI, but there hasn't been a whole lot of compelling software companies to invest in that were solving good problems in my paradigm, where there's a clear problem, there's a clear solution, and it costs less than the problem.
Okay, and so the companies that are best positioned, who are your top picks and why?
So I'm going to concentrate on the semiconductors, and this is kind of weird. I love Micron. Micron is a weird, it's not really a semiconductor company. They're more in the area of memory. But they have been able to come up with fast memory that NVIDIA is using on their chips. And I'm thinking whoever is NVIDIA's competitor is going to be forced to use it's called DRAM. We're nerding out right now, but DRAM is really important for these chips that are doing the AI processing. So we like them. The second way to play this is software that designs chips. And we like Synopsys. And they are buying a favorite local company of ours called Ansys, which does engineering simulation where you can, you know, test out, do online prototyping instead of physical prototyping. And they do have a lot in the electronic design automation space as well, which is why Synopsys is buying them. But anyhow, so we like that company, Synopsys and Micron, and they're not necessarily directly in the line of fire, but I think a lot of whoever wins in the AI chip race might use their products.
Fortunately, Kimberly, our viewers are looking for that deep analysis that you just provided, so nerding out, totally kosher. Thanks so much for taking the time here with us. Coming up, everyone, we dive into some alternative assets that you may want to consider adding to your portfolio. That's next on Wealth. Gold prices are ticking slightly lower today, just off of its fresh all-time high from last week. Gold is broadly considered a safe haven asset, which means it's considered stable, it holds its value, and even grows even when stocks and bonds are experiencing volatility. So for those curious about adding gold to your portfolio, we've got the tips for you. Joining us now, we've got personal finance editor Molly Moorhead. Molly, good to have you here in studio with us. For all the gold curious people out there, lay out the key steps in the gold investing process they need to know.
There's a lot of those gold curious people right now. So step one would be, what's your goal? Why do you want to own gold? I think interest grows when there's market volatility, and so that's what we're seeing now. And you need to know why you're buying it. A good reason is for diversification. It's an alternative asset that holds its value even when stocks are kind of all over the map. It's also can be a form of currency if you're really worried about the value of the dollar. So just know why you're buying gold would be step one. Step two is the allocation. You do not want 80% gold in your portfolio. Okay. Tip from me. The standard advice is something like 5 to 15%. Again, because it can be a good hedge against other volatile assets, it can be an insurance policy as an alternative currency. And then step 3 is what form you're going to buy it in.
Yeah. And so with that in mind, let's explore those different forms of gold. I mean, I always had the thought coming into many of these conversations years ago, like, all right, am I buying gold bars? Do I need an amazing vault in my apartment in Brooklyn? How am I going to get the permits to make sure that I can add on that vault? Let's explore those different types of gold, though. What are the pros and cons of physical gold versus stocks and ETFs?
Yeah, so you really can buy physical gold and put it in a safe in your house. That's the obviously most direct way to own it. The purest form of gold. It's the con is you have to store it.
Yeah.
But there's no management fees for your gold bars. A second way to buy it is buy stocks in gold mining companies. So these are just stocks you buy on an exchange like any other. They're fairly liquid. But one thing to note is that stock shares have often been lower than the spot price of gold historically. Finally, gold ETFs. So these are exchange-traded funds that invest in physical gold and gold mining companies, and then you buy shares in those funds. And so this is kind of a low-maintenance way of investing in gold.
Is there anything else people need to consider, especially as they're identifying what their entry point might be, given the trade that has really run to new all-time highs over the course of this year, even though we're seeing a bit of a pullback today?
Right, but it's important because of the heightened interest is that, in general, you're going to buy gold and hold on to it. So just know that when you, just decide to buy physical bars or invest in an ETF, this is not something you're going to trade frequently. This is something to buy and hold on to, again, to have diversification in your portfolio and a little bit of insurance against volatility.
All right, so I will keep my Costco gold bar tab open then on my laptop. I appreciate that.
Good call.
Molly, thanks so much. Another potential alternative investment to add to your portfolio, municipal bonds. Here to break down what they are and just how they work, we've got Doug Huber. He is the Deputy Chief Investment Officer at Wealth Enhancement Group. Doug, good to have you here in studio with us.
Thanks for having me.
All right, so let's just start there. How do municipal bonds work? Why are they attractive potentially in a market like this?
Yeah, sure. I think, at their core, they're just debt issued by state and local governments to fund projects, right? Bridges, schools, highways. The big benefit is that they have tax advantage benefits, right? Their yield is typically tax exempt from federal or state taxes. And so for clients that are in high tax jurisdictions like a California or New York, they can be really interesting from a fixed income investment.
Do you have to live in the jurisdiction in order to participate in municipal bonds?
No, absolutely not. Anybody can buy them. I think it's just more advantageous if you live in California and you pay California taxes. If you own California municipal bonds, that income stream is not subject to that tax.
What's a good rule of thumb in terms of the returns that you should be looking for from municipal bonds?
Yeah, I think there's a couple ways to look at kind of, are they valuable today, right? One we frequently look at is just, we call it the tax equivalent yield, right? So what would a taxable bond, one that you would pay taxes on, need to yield to meet the same yield that you're getting from muni bonds today? And so interestingly, I think, the municipal bond index is probably yielding around 4.1%, give or take right now. The tax equivalent yield for a similar security is almost 7%. So that means you got to probably get, high yield type exposure to get that yield. So it is attractive from that perspective. Another way we can look at it is what we call the muni treasury ratio, right? And oftentimes, I think for the 30-year average, munis have been roughly 84% of the yield of US Treasuries. Today, they're 92%. And so you're getting that pickup. They generally trade below that kind of parity because there is that tax exempt benefit. But I think anytime it gets, into that 90s to 100 range, that's when people generally are going to say, hey, this is looking like an opportunity today.
What is the issuance process for municipal bonds?
Like I said, they're issued by state and local governments. I think the bigger issue is that it isn't a liquid market, right? It's typically individual investors. There's obviously managers that invest in these, so typically done in separately managed accounts, mutual funds, ETFs. But as a holistic asset class, it is less liquid than you might see in investment-grade corporate bonds, U.S. Treasuries, even the high-yield market. It's just not as big.
Who is the type of investor then, with that liquidity profile in mind? Who is the type of investor that would be apt to layer this into their portfolio, and at what juncture in their perhaps portfolio build-out process?
Yeah, absolutely. I think this is an alternative to traditional taxable fixed income, and I think the typical investor you would see in this is a high or ultra high net worth individual that is usually towards that top tax bracket, and usually in states that have high marginal tax rates, right? This is less of an issue for a Florida resident, right? It is there's big issuance in New York, Massachusetts, Minnesota, California, those high tax states, because it's attractive, right? And so it's usually high and ultra high net worth individuals, and they take some piece of that fixed income pool, whatever that allocation may be, and put it into muni bonds to complement their taxable fixed income.
Doug, thanks so much for taking the time here with us in studio.
Absolutely. Thanks for having me.
Certainly. Coming up, a record number of starter homes are coming with a $1 million price tag. What that means for potential home buyers. That's next on Wealth. We're excited to partner with Synchrony Bank, our premier sponsor for Wealth. Synchrony Bank is working with Yahoo Finance and Wealth to bring you the insights for your personal finance playbook and help you make your money work for you. Let's get a check-in on the markets as we're taking a look at the major averages in this trading session. 2 hours into the activity here, we're seeing the Dow actually slipping fractionally lower by about 0.6% here on the day. You've got to look at the NASDAQ composite as well here, and I'm also going to put this on an intraday view just so you can see what's kind of transpired. And we're off of the session lows, but still down by about 1.4% for the tech-heavy average. The S&P 500, you're seeing that lower right now by about 0.9%. Again, same case there. We're actually in that ballpark of some of the session highs, though still down on the day, fractionally as it may be. We are improving. Let's take a look at some of the sector moves that we're also tracking over the course of today's trading activity. We've been watching more laggards than leaders. Right now, though, we do have staples in positive territory. That's higher by about 0.3%. But being in the caboose portion of the train, you've got energy right now. That's down by about 2.3% here. You also have consumer discretionary down a little more than 2% as of this juncture. And then just lastly, we'll ride out with a look at the NASDAQ 100. A lot of red there. We got a few more of the tech companies reporting over the course of this week. In totality, we have 4 of the 7 Mag 7 companies reporting during this trading week. A big week for the S&P 500s as well. And so just taking a quick look at the NASDAQ 100 as we're taking a look at the mega cap tech stocks, you've got all of the Mag 7 in the red as of right now. We'll continue to track that as we go on throughout the rest of today's trading session. U.S. pending home sales jumped 6.1% month over month in March. That's according and compared to the 1% growth that was expected. I want to bring in Orphe Divounguy, who is the Zillow Group senior economist. Orphe, great to speak with you again. I want to know what you make of the latest data.
Look, we expected it, right? The big theme here is price cuts sell homes. When you're looking at where the home sales actually exceeded expectations, they're in the South. They're in places where you saw a big increase in inventory. And we're seeing more price cuts. According to Zillow data, potential buyers have 19% more options to choose from when compared to a year ago. And basically, we're seeing a record number of price cuts. Roughly 24% of listings had a price cut in March.
And so with this in mind, while the average starter home in the U.S. costs just under $200,000, Zillow found that in 33 cities across 25 states, starter homes now come with a price tag of $1 million or more. That doesn't sound like it's helping out what we've covered and what many economists have been tracking with the affordability crisis in homes. So how did you define a starter home for the data?
Yeah, of course. A starter home is basically a home at the bottom of our home value distribution. Basically homes in the lowest third of home values. And the reality is, look, we expect price growth to continue to moderate as we see more and more homes return on the for sale market. But essentially, the rapid increase in home prices over the past few years really means that a starter home has gotten very expensive. You're seeing these homes throughout the country. It's not a California issue alone anymore, right? It's not just California. Half of U.S. states have at least one city with $1 million or more or higher starter home.
So as you think back to the pandemic and how things dramatically changed for home prices during that period. How has that almost kind of reset the thought process for people who are in homes, who otherwise would be listing their existing home, adding supply back into the market, and how long we anticipate some of those ramifications to continue to play out?
Yeah, look, we're seeing sellers return. And so I think that's the good news. And they're coming back because essentially mortgage rates are lower than they were a year ago. That's one reason, but also people need to carry on with their lives. We know from our data that the number one reason people move is life events. So if you've delayed the decision to move for a couple of years because of a ton of uncertainty in the headlines, now is probably the right time. There are more options on the market. Buyers have a little bit more bargaining power than they've had in a long time.
So how is this impacting the rental market?
Yeah, look, we're seeing the rental market has cooled, right? We had a big increase in apartment building deliveries in the past couple of years, a record increase, in fact, the highest in almost 50 years. And so you had a big increase in supply in the rental market that has helped to cool down rent growth. And now we're starting to see, right, rent prices are growing at a lower pace than wages. And we're starting to see affordability also improving in rental markets across the country. And so that's going to help stimulate rental market activity, right? Renters are going to be able to start moving again at a more normal pace.
Now, I want some good news to share with potential buyers right now. Are there any silver linings that you're seeing show up within the data right now, Orphe?
Yes, we're seeing a price moderation. Our forecast shows that price growth could continue to ease and maybe even decline in 2025. But essentially, we expect existing home sales to increase, right? Again, price cuts sell homes. Sellers who are making the price adjustment, right, to help buyers are the ones that are selling their homes faster. You're seeing it with builders. Builders are cutting prices, providing incentives for home buyers. And of course, you're seeing new home sales continue to exceed expectations month after month.
If that were the case and that were to play out, which on headline it sounds great. You want more buyers to have the opportunity. You want more sellers to feel like they are confident in listing their homes. But if you look on the whole of what would need to take place within the economy for that to actually be the reality, coming off of a print like we saw this morning in GDP and the first contraction in 3 years, what would that spell out for the housing market if we were to continue to see even more of that contraction in order for us to actually get to some of the levels that you're talking about?
Yeah, totally. I mean, the GDP print, I did take a look. It came from imports, right? So if you have a big surge in imports ahead of the tariffs, imports actually increased. And so if you have a big increase in imports, you get basically, imports get subtracted mechanically from the GDP number. And that's why it was negative. Actually, domestic spending has been actually very robust, increasing roughly 3% in the latest print. So I wouldn't be too concerned about the first quarter GDP numbers. I think what you need to look at is the jobs report that's coming out later this week. As long as people have jobs and the unemployment rate remains very low, that combined with lower mortgage rates this year compared to last year ought to be positive, a major tailwind for the home shopping season this year.
We're absolutely going to be watching the employment situation data as that comes out on Friday. We've got an entire special tied to it. Orphe, thanks so much for taking the time.
Pleasure.
Great to see you. Coming up, we're checking in on Main Street for a look at the challenges facing women-owned small businesses. That's next on Wealth. Women are one of the fastest growing groups of new small business owners, but they still face big challenges, especially when it comes to funding. Nearly 90% of women reported relying on personal finances and credit cards to fund their own businesses, according to data from H&R Block. And with high interest rates and tariff-fueled inflation in play, it can be tough out there. Joining me now, we've got Jamil Khan, H&R Block Chief Strategy and Small Business Officer. Jamil, good to take some time here with you to discuss this. Very important. Talk to me about the hurdles that you're hearing female founders are facing when looking to run and operate small businesses.
Hi, Brad. Good to see you again. Yeah, there's many hurdles and also some positives. So we've seen, I'll start with some of the positives. We've seen that women-owned small businesses are growing at twice the rate of male-owned small businesses. So that's a good positive there. And 40% of them expect to see growth within the next 5 years. But on the other side of the equation, our research has shown that 42% of women-owned small businesses who applied for a bank loan are being denied that. And related to that, around 90% of them are funding their business with their personal finances and their personal credit cards. So just making it harder to run their business there. And that's why we've launched this Fund Her Future program to help address some of that imbalance.
And so based on what you're seeing, how would you characterize the overall sentiment of small business owners right now?
Yeah, it's an interesting one. So, I've spoken to our tax pros who have recently engaged with small businesses across the United States. And I think there's some anxiety out there about the state of the economy. And what we're seeing, in particularly with product-based businesses, makers and sellers, there's uncertainty around supply costs, delays in inventory, access to supply. And what that's doing is just creating a bit of stress. They already have very thin, tight margins, and that lack of certainty is really playing on them. A couple of themes we've heard is that, typically, small businesses across the US keep a few weeks of money for a rainy day. They're trying to build up that capability there. And I can share one additional statistic that I came across recently. Only 21% of small business owners are expecting economic conditions to improve, and that is down 16% from February. It's one of the biggest decreases since the pandemic. So there's definitely some anxiety out there due to a lack of clarity on how the economy will look.
And so within that, and of course, it's the T word that it comes back to, drilling down into tariffs, how, if at all, are you hearing small business owners being impacted at this juncture, and how are they trying to best perhaps, mitigate some of their vulnerability at this juncture?
Yeah, I don't have specifics on tariffs per se, but I think that's related as part of the overall economic anxiety that we're seeing, and particularly on supply chain. So I just think there's that general, lack of confidence there. The other theme I've heard is a concern about pricing. We've been through many years of inflation and a concern about increasing pricing. If your costs go up, should I be increasing pricing? But they know that there's only so much that customers will bear. So it's definitely on people's minds.
And so going forward, small businesses and their outlooks, what are you hearing kind of on aggregate about how they're looking through the next few months?
Yeah, I mean, the next few months, I think it's caution. I think they're going to be very cautious about how they spend their money. They want to keep their customers happy, but I think there's some unknowns there for sure.
And so as you're thinking about making sure that, and this is where we began the conversation, that women-owned small businesses and operated small businesses are having the access to the funding that is necessary as well, what are some of the constraints that you've heard about, and where we should see the system actually doing more work to make sure that these businesses are insulated from shocks, but also well-positioned going into the future on a capital basis?
Yeah, I think what they're seeing is, as I said before, it's loans. They're going to banks and they're being denied, like 40% of them. In terms of solution, I think there's some wider things, but what I talked to about is that's what we're trying to do. We're trying to help them understand their business more. I think one of the things that, women-owned small businesses and all small businesses suffer with is just understanding, the admin and complexity side of running their business. A quote I've used a few times with my team is, someone who just started a new bakery didn't open that bakery so he could spend Sunday afternoons doing bookkeeping. And I think, understanding their business will really help them. So, bookkeeping, payroll, and tax, as we do that for our customers, they can start seeing their P&L for the first time. They don't understand how their money comes in, what their outgoings are, and how that translates into a P&L. And understanding those facts will then help them get loans and help them to go and understand the flow of the cash for their business. And I think some of that just financial education will help them as well.
Jamil, thanks so much for taking the time here with us. Really appreciate it.
I appreciate it. Good to see you again. Thank you.
Coming up, another tech company just threw its hat into the AI app ring. We'll tell you whether it's worth a download next. President Trump is participating in a cabinet meeting at the White House right now, addressing tariffs and the latest economic data. The president blaming today's weak GDP numbers on the Biden administration, also saying that tariffs haven't kicked in yet. Trump also saying he knows China is doing poorly right now and is saddened to hear China is getting absolutely hammered. Trump saying he hopes a trade deal with China will be made. We will continue to monitor anything from the meeting coming forth. We know that there are going to be several CEOs that are also present at the White House, as there is more of an Invest in America event taking place as well. It is time for Tech Support, our weekly look into all things technology, and the tech giant is jumping into the AI game. Meta launching a brand new free AI app available on both desktop and mobile that can answer written questions or generate images. Joining me now with his take is Yahoo Finance tech editor Dan Howley. So far, what exactly can this do?
Well, I have it right here. I downloaded the app itself. I don't know if we can get a look at. Oh, there we go. Yeah. So you can kind of see it's similar to what you might have with an OpenAI or Google's Gemini. Basically, it's just you get an interface, and then you can do things like ask it questions and ask it follow-on questions. It offers you, so you sign in with your Facebook or Instagram account, and it asks you things like, okay, so where should I start? Let's get to know each other. It's supposed to be personalized over time, so that as you use it more often, it'll give you better answers to what you have. You can also do things like play 20 questions or restyle photos. There's also a discover page where you can see things like what's going on. This is the papal conclave reimagined as whimsical fairy tale scene. So a lot of this so far is kind of AI slop. You're just kind of going through this, and I mean, I think we have some pictures. One was a image of Jesus washing away the sins of Vegas. This is what it would look like if people dressed as with croissants for fashion show. Zuckerberg obviously is seemingly some kind of Caesar-like figure. A bed made out of mashed potatoes. Yeah, so this is all the stuff that's like flooding that Discover feed right now. Not great, not a great look out of the gate. But the idea is that this would be an AI app onto itself. So Meta talks a lot about how we have 1 billion plus people using Meta AI. It's built into Instagram, Facebook, WhatsApp. So when you go to that top of the screen and you tap that search bar, I guess technically you're talking to Meta AI. But if I'm looking, for someone in Instagram or on Facebook, that doesn't mean I'm trying to use it as an AI. I'm just trying to use it to search for people. So this would give, I think, people a better idea, investors a better idea of who's using Meta AI and why. I think that the idea is that this has to absolutely catch on as its own entity. It's competing with OpenAI. It's competing with Perplexity. It's competing with Google's Gemini. I guess Siri to a degree, if you want to include that. But this has a huge base of people already built in as far as Facebook and Instagram and WhatsApp users. They just have to make sure that this app itself does well if they really want to play in this space. The Discover feature, not great, obviously, as I showed, but the answering questions, things like that is pretty impressive so far. And obviously you can do things like get notifications. You can go back and check your history for things that you may have been searching for or using it for. So it's certainly a means for Meta to push itself further into the AI game.
All right. I didn't have croissant fits at Fashion Week in my bingo.
Yeah, neither did I.
But we will see all of the multiple use cases that people will find for this app here. Dan, thanks so much for breaking this down and some of the early advancements or uses here with the app. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. We'll count you down 2 and